Today, we're going to talk about accrued expenses. And don't worry, it's much easier than it sounds. Take a look at the question on your screen. Have you ever received a bill after you've already used the service? Most of us have experienced this. You use electricity all month, then the bill arrives later. You use the internet first, then pay the bill afterward. Now here's the accounting question. When should that expense be recorded? Is it when you receive the bill? Or is it when you actually use the service? That's exactly what we're going to answer today. Let's begin by understanding what an accrued expense actually is. Accrued expense is an expense that has been incurred by receiving goods or services but has not yet been paid because payment will be made in a future accounting period. At first glance, that definition might sound a bit technical, so let's break it down into something much simpler. Expense incurred but not yet paid in cash. That's the key idea I want you to remember. Now look at the flow at the bottom of the slide. First, the business receives or uses goods or services. For example, it might use electricity, employees complete their work, or interest builds up on a loan. Next, the business has already received the benefit, hence an expense is incurred. Even though no money has been paid yet, the expense belongs to the current accounting period. Finally, the cash is paid later, usually in the next accounting period, once the bill is received or payment becomes due. So whenever you think of an accrued expense, remember this simple order. You receive the benefit first, then you recognize the expense, and then you pay the cash later. This flow will help you identify accrued expenses much more easily when we start looking at examples. Let's continue with Alex Consulting Business. At the end of January, Alex Consulting Business owes $200 for electricity used during the month. The bill will be paid on February 10. Here's something to think about. Should the expense be recognized on January 31 because the electricity has already been used? Or should it be recognized on February 10 when the bill is actually paid? Take a moment to think about your answer. The correct answer is A, January 31. The key word here is incurred. Since the business has already used the electricity, the expense belongs to January, even though the payment will happen later. To record this, we debit utilities expense because the business has incurred an expense. And we credit utilities payable because the business now has an obligation to pay the utility company. You'll also notice that cash isn't part of this journal entry because no payment has been made yet. This journal entry records the expense in the correct accounting period and recognizes the amount that is owed. Now let's see what happens once the bill is finally paid. A few days later, on February 10, Alex pays the electricity bill. At this point, the liability is settled. Utilities payable is debited because the amount owed is no longer outstanding. And cash is credited because money is leaving the business. Notice something important here. We don't record utilities expense again. That's because the expense was already recognized on January 31 when it was incurred. Today's journal entry simply records the payment of the liability that was previously recognized. Remember, expense is recorded only once, when it is incurred. To recap, let's put everything together with one simple timeline. First, the business receives goods or services, and as a result, expense is incurred. Since payment hasn't been made yet, the business records the expense along with the payable. On the slide, you'll notice I've written XXX expense and XXX payable. I use this because the account title will depend on the type of expense. For example, if it's electricity, you would record utilities expense and utilities payable. If it's salaries, you would record salaries expense and salaries payable. If it's interest, you would record interest expense and interest payable, and so on. The account names may change, but the process remains exactly the same. Later, when the payment is made, the payable is removed and cash decreases. Once you understand this pattern, you'll be able to apply it to many different types of accrued expenses. Now let's finish with a quick challenge. Look at the situations on the screen and decide, which one is an accrued expense? Take a moment to think about it carefully. Don't overthink it. Just apply the rule we learned today. Now drop your answers in the comments. And in the next video, we'll break down prepaid expenses, where the timing flips completely and the cash is paid first before the expense is recorded.